Now, one of the things everybody's been asking is, uh, with the markets moving the way they do, like the kids would say, the markets are moving mad. Is there an opportunity to make money? Number one, and number two, isn't it dangerous to trade? Now, the truth of the matter is, it is dangerous to trade if you don't know what you're doing. It's like giving a gun to a person. If the person is a policeman, that gun could keep a neighborhood safe. If the same person is an armed robber, it could keep the community or make the community dangerous. And if the person is a child, everybody, including the child himself, is at risk. And so you're going to find out, as happens in every market crash, that those who don't know what they're doing get in trouble. And so the principles we've been teaching, the concepts, especially things like risk management, this is the time to have tight risk management. 1%, maximum 2% risk, and that's it. Take the loss and move on. Take the reduced profit and move on. You need to be very, 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 did I mention very disciplined with your rules-based trading right now. You do not want to be caught on the wrong side of a landslide because you could not be disciplined. So in the market right now, we're seeing what we call increased volatility. And all volatility is, like we talked about in the past, is how fast and how wide a margin Forex pairs or any other asset class move when you're trading them. As traders, we like volatility if we know what we're doing. If you don't know what you're doing, volatility becomes, again, a double-edged sword. But increased volatility doesn't change the rules of price action. Liquidity profiles, time zones, the CMRT model we talked about, contraction, manipulation, expansion, retracement, target. All those things are actually accelerated. In essence, volatility makes things move quicker. That's all. Now, an aspect of the volatility which we need to be careful about is the fact that there's certain fundamental things going on that affect price action. The vast majority of time, things like news events and stuff of that nature are what I call fake fundamentals, because the market has already kind of priced them in anyway in advance of them. And so all they do is increase liquidity into the market for short, sharp periods of time to drive objectives. It is the things that the market cannot foresee or cannot possibly prepare for, like a virus, like an economic crash, like a natural disaster. Those are the things that really can mess with your expectation of price action. In essence, when those things happen, they invalidate our predictions. But the fact that they're invalidating our predictions does not mean that they invalidate price action. So we trade based off price action based on what we predicted. We wait for what we predicted to be confirmed. Then we let price action guide our response. What unforeseen things do is they make our predictions wrong. They don't invalidate price action. And so if you know how to respond to what you did not foresee, and that's why we don't just trade off our hypothesis at IKW, Israel Keys Wealth, we trade based off the confirmation of our hypothesis. So we're expecting something, we're ready for it, and then we go with it when it's confirmed. Well, if what we're expecting doesn't happen, if it's never confirmed, if the market's doing crazy things based on the fundamental, we can still follow those things through based on our understanding of price action. The caveat is where you see whipsaw, where something happens on a Monday, something else happens on a Tuesday, a third thing happens on a Wednesday. And so in this moment, I am more, what's what I'm looking for now? I'm more of the mind. I'm more inclined is the word I'm looking for. I'm more inclined to be a day trader and an intra-week trader. I'm not really trying to hold for long periods of time because the markets are reacting quickly one way and then the other. And this is why understanding trading as a field of study comes in, as opposed to just trading somebody else's strategy, because you know what tool to apply. So in this moment, with all the volatility and the lack of clear direction, I am going in and out in a day or in and out in a couple of days. I'm not staying in over the weekend. I think I put this on the group last week to be careful that I saw a gap was going to form over the weekend, and it formed literally an hour after I said it would, because I just looked at the market and I said, this is textbook profile for a gap. And that's why I'm not holding over Friday, because if I'd been holding on Friday and my stop loss was covered by the gap, now the price came back in the direction of the gap, but there are gaps that could carry on for hundreds of pips before you know it. And then you don't have a stop because your stop loss has been gapped through. By the time the price opens up, the trade will stop you out far further than when you intended to. And so these are some of the things you need to bear in mind. Follow rules, stick with your level of expertise, don't try and overdo it. And if you're not yet an experienced trader, this is the time to stick to your demo. Now, having said that, a couple of things to deal with. I put this on the group about a week or so ago. I set everybody an assignment. I don't know if I did this on the free group or just on the paid group, but I said everybody should go and study the concept of risk on versus risk off. Risk on, let me increase that. Risk on versus risk off. Let's make that bigger. There we go. Now, this is a concept in trading, which is almost as old as trading itself. And it shocks me how many people don't factor this into how they trade. And it's one of the fundamentally driven principles of trading. This is very simple. There are certain currencies that are seen to be safe havens. Bear in mind, when we're trading currencies, like I touched, you're trading literally one economy against the other. So you're literally trading the overall impact of one economy over another. Certain economies are known traditionally to be safer than others. And two of these particular economies, one are the US dollar. That's the American economy. Let's put this here. 1 second, safe haven. Economies. The US dollar, because the United States has been seen over the years as being the most stable or the biggest economy in the world. Now, you could argue that's on the threat at the moment, but that's neither here nor there for now. Whenever there is economic uncertainty, people tend to move their money from what they consider to be risky economies into what they consider to be less risky economies. So it's simple. If you think there's a high chance that banks are going to go bust, you are going to move your money from a bank that offers high interest but is new and slightly less stable, into a bank that may offer you slightly low interest but you believe is safe and is too big to fail. Also, you could go from an account that is a high risk, high reward into something safe like a treasury bond or government-backed treasury bills. And so the United States dollar is kind of seen, again, this is dating back 20, 30, 40 years. Some of this is becoming blurred because the world isn't what it was 20, 30 years ago. For instance, the US dollar or the United States economy isn't seen to be as robust as it was 20, 30 years ago. So it's no longer just black and white, because in trading, remember, all we're really doing is responding to people's emotions. But still, largely, it is still seen to be that way. And so the first one you want to look at really is the US dollar. That's the first thing. So when in an economic crisis, when people think the market is too risky, you start to see people stocking up on the US dollar. If you look in 2007, 8, and 9, when most of the world markets fell, it seemed that the US dollar gained a whole lot of ground against many of the other currencies, because people are banking on the fact that of all the economies in the world, the US economy is the least likely to be allowed to fail. And therefore, the US dollar is pretty much the safest currency to hold on to. The Japanese yen, to a far lesser degree, is also kind of seen as a slightly safe haven, but nowhere near the dollar. So where currencies are concerned, we're going to just use the dollar as that one. Now, a second thing that people tend to run towards in these kinds of issues are precious metals. So we'll put that in, precious metals, e.g. gold, silver, platinum. So you will see that in this kind of crisis, generically, again, it's not a perfect science, but generically, the price of these commodities tend to go up because people are investing in them. Now, we usually trade these commodities against the dollar. So if the dollar is going up and these commodities are going up as well, if you're trading one against the other, you might not see much of that volatility, which is why now you have pairs of the commodities against the euro or the commodities against the pound. You will see a lot more volatility in those. But generally, people are moving their things, their investment into precious metals, into the dollar, into things like, let me add a couple more. As Forex traders, you might not use these as much, but I'm going to add them anyway. Treasury bills or treasury bonds. One quick second. So yeah, treasury bills, treasury bonds, things of that nature. In essence, this is a government, we call them government-backed securities. So the only way you lose your money on these things is if the entire country goes belly up. And so this is what happens in a risk-on scenario. Now, in a risk-off scenario, the opposite happens. People invest in other currencies because these other currencies seem to have higher yields of interest and things of that nature. I understand this is not an advanced class, so I'm not going to go into too much. In general, what are you seeing? You'll notice that whenever the markets think the economy is getting worse, the dollar starts to rise. So for instance, let's look at the euro dollar now. Over the last, let me see now, control. And let's look at the euro dollar over the last few template. Let's pick a template, RKG simple. So following the whole coronavirus thing, let's look at this in days now. If you notice, when the thing really hit, when all the news was going on, that was roughly about the start of last month. So this is the 9th of March. Look at the sharp dive from the high there, all the way down, 868 pips in 9 days. In 9 days, we had almost 1,000 pips drop. Or is it more than 1,000? No, 1 second, let me see. Yeah, it is. Yeah, it is. It is roughly 1,000. So 1,000 pips, pretty much 1,000 pips in just over a week. That's crazy. in recent times, with the government beginning to put their measures in place, the quantitative easing, the stimulus packages in different nations, in essence, global governments started to behave like they were going to try and get the stuff under control. You see that the markets now rallied. And so over the next 5 days, there was 510 pips, an average of 100 pips a day. That's against the euro. Now, bear in mind, the euro is a basket of almost 20 countries. So it's smoother in its movement because there's more diversity in the economies that make it up. If you look at the pound, which is just one currency, you see that it's more pronounced because there's less diversification. We're talking about just one country here. In essence, everything rises and falls. For instance, if one or two countries fail in the euro or doing very well in the euro, the others can pull them down. If one are up, but yeah, you have a single country currency, and so the effects, good and bad, are magnified. And again, see this? In the same period, in fact, this was in 6 days, no, 9 actually. Let me go from here. So again, in 9 days, it traveled almost 2,000 pips because of the fear, and it cleaned out. See, this was the low based on Brexit from last year, the Brexit worries. In 9 days, it wiped that low out because people are really worried that the economy is going bust. On the flip side, when some of the measures began to happen and people thought, Corona was slightly more under control, the government were putting stimulus packages, it went up about 1,000. So this is in essence, bear in mind, we're going against the dollar. So let's look at the dollar here. Let's look at the dollar index to show you what I'm really talking about. Right. Show all. Okay, I don't have the dollar index on this particular broker that I've opened. Okay. Oh, that's a shame. I want to show you the dollar index. Okay, let me go to another account of mine. Right. So, okay, so this is the dollar index here. Let's look at the same amount of time. As you can see, all this happened to the dollar. So there's not much, as you can see here, you can see that the whole, compare this graph with this one. Let's see if I can put them side by side here. So that's one. Let's look at the euro. So this is the euro one. This is the euro one. Right, we're looking at, okay. And that's two. Okay, let me use this. So as you can see, one is almost pretty much the inverse of the other. While, actually, let me put them, I know what to do. Rather than put them side by side, I'm going to put them one in front of the other, one on top of the other, so you can see what I'm talking about. Let's take that off. And here we go. So as you can see, so now they're almost, let me see, I think that, yeah, they're almost perfectly, not quite, but almost perfectly aligned. Okay, good. So they're aligned now. So you can see this, right? That while the dollar index, now this is just tracking the US dollar's movement. as a currency on its own, the value of the currency without comparing it with another currency pair. As the dollar was going down pre-corona crisis, this is pretty much the point at which the corona crisis started to kick in. Put that in red. So it's bright and clear. And we're going to drop another line in red here. Right, so this is the point we're looking for. So the 9th of March is pretty when the bottom started to fall out. So the dollar was going down up until then to start the year, as you would expect, or to end February, so as you'd expect, because everybody thought, the markets are going well. And then when we got here and the corona thing just really spiked, the US dollar just shot up like it stole something. And as the US dollar was shooting up, as you can see here, the euro was falling out of bed. And then on this date here, the 20th, let's put another line there. On this date there, the 20th, when investors started to feel a bit happier about what was going on in the markets, the dollar now started to fall and the other currencies as well. So this is a perfect example of how fundamentals can affect price action. So I told you guys in the group from 2 weeks ago, remember, I said, go study risk on and risk off because I knew this was going to happen. It was predictable. I didn't know the exact date each would kick in. And sometimes you can see this from day to day. You can have one day where everybody's happy about the markets because they think the government's doing something well. And then the next day you hear that 5,000 people died worldwide from corona. And you can have risk off from day to day, from week to week, from month to month. Sometimes you can have risk on and risk off from session to session. London is risk on, New York is risk off, or vice versa. So now that we have looked at all that, let us go back and now look at price action. In essence, we have a filter, fundamental filter that tells us when news is coming out that is good for the global economy, we expect the US dollar to fall slightly because people are more willing to take risk. But when news is coming out that is bad for, again, this is an oversimplification. There's levels to this, but I'm just trying to keep it simple for the new traders among us. When news is coming out that's bad for the global economy, the flip side is going to happen, and we expect the dollar to rise and the other currencies to fall. But we're keeping all our price action in place. So let's go back and look over the last few days since the 9th of March. Let's review what's happened over the month of March to see how the stuff you're learning works like a charm. So this is the 9th of March here, right? This is the date in the sand where everybody felt the world was going to fall apart. That's it there. Over the next 9 days, because of risk on, the fundamental drivers are pushing the market down. But how is it moving down? It's moving down according to textbook price action. Textbook. I think people are trying to figure out, one second. Yes, it is already on. We're on now, guys, you're late. So textbook price action. So this is the 9th of March. We know based on the fact that risk on is kicking in, we're expecting stuff to start to go south. So remember the stuff we've talked about. First of all, we're looking for daily bias. We're looking to see a daily engulfing. Well, what do you know? Here it is. That's the daily engulfing here. Look at this here. On this day, what day was this? This was the 9th of, no, that was the 10th of March. So on the 10th of March, in the euro, price closed beneath the previous day. Let me take that line away for now. So that's the previous day's low, right? Price closed beneath it on the 10th of March. So we're going to bed on the 10th. Now, if you are an experienced trader, you don't need to have waited for the next day. But I want to keep this simple. I don't want some of you getting confused and losing money. That's why the daily engulfing is the safest bias filter for the direction of your trade. If you know what you're looking for, like I and some of the advanced traders do, there's things that you can employ. However, I wouldn't advise them. But on a 15-minute chart, this is what it looks like. So this was the low of price that day. Where it opened up was the low. And as you see, on the 10th here, price went beneath it and closed beneath it. So we have the classical daily engulfing pattern that tells us price has changed direction. And we know that we are in a risk on market. Does that make sense? We know we're in a risk on market, so we're expecting the dollar to appreciate, in essence, the euro USD to go south. And then we see that expectation confirmed by a daily engulfing. And so when we woke up on the 11th of March, which was, 1 second, let me just check the calendar real quick. What day was the 11th of March? Can somebody let me know what, actually, no, I know. The 9th had to have been a Monday because we go from 6 to 9 on the chart. So the 9th had to have been a Monday. So the 11th, the 10th would have been a Tuesday. 10th would have been a Tuesday. And so when we wake up on Wednesday, we're in the sweet spot. Also, let me add this. One of the things that a market crisis does is it flexes the rules of days and times a little bit, because now the market's responding to real life news in a crisis. So the rules of sit out Monday, sit out Friday, only look at the charts at this time, they become flexed a little bit, because if people find out at midnight something is going on, they're not going to wait till 9 a.m. on a Tuesday to react, because now we're in a real-time crisis. However, you will still see that the times of the day are still very critical. While the days of the week may be a bit more flexible, you're still seeing the majority of the stuff is happening in certain times, because these are the times when people are awake in certain parts of the world to act on the information. Please let me know that you guys are tracking with me so far. So we wake up on the Wednesday on the 11th of March, and we are looking, 1 second. We are looking for an excuse to short, right? We're looking for an excuse to short. Now, let me put in this template that shows you my Asian range, and there we go. So basically, this blue boxes here are a certain range, and this yellow boxes are a certain range, but together, crudely, technically it's the orange box that's the Asian range, but just for the sake of our newcomers who don't understand some of the deeper stuff, or the new traders, we're just going to call them the Asian range altogether, right? So from when this line opens to the end of that, and you will see that in a crisis, the Asian range is not as defined as it used to be. So pre-corona crisis, you can see these are very small periods of time. See, they're very small periods of time. Nothing's going on there. These are the classical, when we talk about the CMERT, consolidation, manipulation, expansion, retracement target. For day traders, the Asian range is usually the consolidation period where price is held in a tight range And then when it expands one way to manipulate, it then goes the other way. In a crisis, people are figuring out what to do even in midnight. And so you see these ranges starting to get wider because people know that anything could happen to their money, and so they're less likely to just allow those periods of time pass by. But we still know what to do with them. So we come here. Now, remember CMERET. So let's go to a 4-hour chart, right? Remember some of our triggers. So on the 4-hour chart, now, we know we're looking for a short, right? We know we're looking for a short. First of all, 1 second, that's a bit too, there we go. So there's a gap here. Just showing you how price action works. There's a gap here. And we know that when we see gaps, they tend to get filled. So price jumped up through this gap. And so when it comes down and it hits the gap, we expect a reaction of some sort. And what do we know? That we get it. It goes back up a little bit. But we know our bias is still south. So we're looking for an excuse to go south. Well, there's the other side of the gap. This is a trick most traders don't know. But the other side of a gap, when it fills, if you're still looking to go the other way based on the fundamentals, is very important. And so what happens here? Price gets to the bottom of the gap, closes it, and it hangs around here. And so at this gap here, it comes here, right? And it breaks market structure here. So this low here, if this doesn't make sense to you, go look at the other the previous tutorials we've done on. You can find them, the links on the YouTube, whatever. It breaks market structure there. You see that there? And comes back up into this liquidity profile. It's called an order block there. So risk on tells us we're going south. Price closes the gap it made on its way up, comes back to the other side of the gap there. Let me put this here. So this is the other side of the gap. That should be a price level that you should have drawn on your chart if you knew that level of precision. If you drop down to a lower time frame, you'll see that in real time, look at how precise that is. So when price breaks through it, it comes, you see that level there? Guys, please let me know in the charts that you can see what I'm talking about. Let me know by typing in the chart so you can see what I'm talking about. And so it breaks, it comes back to that gap there. And as you can see, it's like magic. Excellent. Yeah, so you can see it good. See that level, how magical that level is. This was on the 11th of March. I remember we were expecting this. We knew we were in a risk on, so we knew the dollar was going to appreciate, other currencies were going to depreciate. We saw the daily engulfing on the 10th of March. And so on the 11th of March, we should have been stuck. We would have been stuck in this. We were waiting for it here. Also, she dropped down to a 1-hour chart. And I think I've explained this before, but for those who haven't heard me explain this, you want use dip. Actually, you know what? I don't have the time to explain this. It's in the tutorials, and and I'll send you the links if you don't know where they are to find them on YouTube. Go watch them. What each different time frame brings to the table. But when you're trading intraday, the 1-hour time frame is your money time frame. It is very, very, very important when you're marking intraday movements. For instance, if I see a 1-hour engulfing against me in my daily bias for that day, I will get out the trade and wait for the 1 hour to engulf the other way before I enter. So for those of you who saw me cut my trade on Friday, it was going well. I was already 4-1 up. And then in 1 hour, it reversed and took me from 4-1 to 1-1. I immediately shut the trade down. And it was the 1 hour engulfing. When I see the 1 hour move intraday, it is gospel majority of the time. And so remember, we have the CMRT model. This here, 1 second, sorry. Actually, no. I want to look at this in a 4 hour chart to get back here. So we're looking for a consolidation. Here's your consolidation. Let me say this because I try not to have to repeat myself from previous lessons, but you need to know what time frame you're really trading, and then you use the higher time frames to give you reference points and bias, and the lower time frames to give you entries, exit, and management. Because I'm an intra-week trader, I'm trading the 4 hour chart. I don't take my entries, exits, and stop losses on the 4 hour chart. I use the daily to give me a bias, the weekly to give me reference levels. I use the 1 hour and the 15 minute to refine my entries and exits and manage my trade. But I'm plotting my trade ideas off the 4 hour chart. Does that make sense? You can, if you slide it down, if you're plotting off the 1 hour, then up and down, whatever you are, you want 2 time frames above you and 2 time frames below you. The ones above you to give you reference levels. For instance, if we go to the weekly time frame, that level roughly there, we know that here on the weekly, and I drew this for many of you, I think I showed you guys this. On the weekly, I drew out that level. My weekly is red. My weekly color is red. And I said, if price rejects through that level there, so that's a reference level on the weekly. It rejected through that level. This was the weekly order block there, right? When that rejected on a weekly basis, I knew, let me put that in red. Actually, it should be in saddle brown. Where's saddle brown? So there. So in essence, the weeklies told me that we're likely to start to go down. The fundamentals risk on is telling me the dollar is going higher because we're in a crisis. Other people are going to be moving to the dollar out of the euro. And then the daily tells me that there is here, that rejection happened and there's an engulfing. So everything is telling me south, right? So I dropped down to 1 hour chart. So it's a 4 hour chart, which is the chart I'm really trading. There's my consolidation, CMERT. Let's put that in there. So there's my C. This is my manipulation going into that level there. Put that in black. And you begin to see that when you understand these things, it's like taking candy from a baby if you have time, unlike I didn't this last few weeks because of my other responsibility. But there's the manipulation. In essence, price is moving away from its real direction. Now, if you're doing this in a 4 hour chart, this happened over, let's see, let's put this in, yeah. So this happened over 1, 2, 3 days. So I'm not saying you couldn't have traded long, because actually this was a perfect setup for a long here. It broke market structure there, returned in, and then went. So, but all the while you're trading these days going up, you're aware, one, there's a crisis brewing. So at some point, the market's likely to go into a risk on scenario. Secondly, you understand, because you're trading the 4 hour, that you're approaching a weekly rejection level. And so you're keeping your eyes open for a daily engulfing. The moment that happens, you know Your hypothesis was correct. So this was a consolidation, right? And then you expect an expansion, remember? CMERT. So there should be an expansion. Let me put this here. And the rule is the expansion should be at least as long and most likely far longer than the manipulation. So I would say anywhere between 1.5 to twice. This is one of the tricks, that I'm giving you now for free. So the manipulation from the center of the manipulation area to the top was 350 pips. So what's 1.5 times 350? Let's do it, calculate it real quick. 1.5 times 350. So that's 525 pips. So I'm expecting this to go anywhere between 525 and 700 pips the other way. And this is 525 here. And it went over 750. Now, also, I'm looking at previous price action levels. So let me put the M there. I'm looking at previous price action levels. That's the M. No, actually, that's the E. Sorry, that's the E. That's the expansion. So rule of thumb number one, anywhere between 1.5 to at least 1.5 to 2. It could be far more. Secondly, what are the price action levels across the way? Well, the first price action level is the manipulation level. So it's the middle or the low, whichever one you want to take. I'm going to take the low for here, but the middle works as well. It's the middle or the low of the manipulation level. So if you're coming down here, you see that reacted that there. That's the first place you should be thinking to get out and see what happens. But then you also have a low here. Actually, let me replace this with things that are obvious. Delete. Delete. So let me use this levels here. So that should be your first level of interest. When you see these lines on my chart, some of my students call them magic lines. This is what the magic lines are. Second level of interest. And you see how price is respecting them perfectly. That's off the manipulation here, this low there, and of course, the final one down here. And you see again, I told you before, you just drop lines on highs and lows from significant levels and price will just respect them magically. And you see the price respects them coming down here. Orange, dark orange. Respects them coming down, but it also respects them going back up. See, look at these levels here. Expects them coming down. This one is something, if you drew out your time all the way back, you would see that this level was from here, but we're not going to deal with it for now. But this does show you what it is. It's the weekly order block here. So that's a weekly order block, the price respected from almost 3 years ago. As you see, price action is undefeated. It is absolutely undefeated. So put that there, just so you know what's happening. Right, so let's come back there. And then it respects it going back up the other way. See, at each of these levels, something happens. And this is not hindsight, like I told you. This is from stuff in the past, some of which I actually put on the group to say, look at these. So now, of course, we see CME expansion, and then there is this would then be the retracement if the risk on holds. Now, bear in mind, if the markets decide that they've done enough nonsense, then this then will become a reversal. If the crisis long-term is resolved, then this will become a full reversal. But at the moment, until we have evidence of that, it is simply the retracement, in which case we could potentially have the real run to target. We don't know that yet. So we don't know whether this continues or it reverses. What will determine that is the fundamentals. But whichever happens, we will be ready because we're smart money traders. So put the question mark there. We don't know that yet. And so we can't. So that's the big picture of what's happening. How could you have profited? Very simple. You drop down to a low time frame. You can go to either the 1 hour or the 15-minute, depending on, I'm going to use 1 hour so I can see more of the charts in one time. Actually, let's use the 15 minutes. Let's use the 15 minutes. So let's go back to the 11th of March, which is when all the magic started happening and we were ready. So what do we know? I told you London Open, New York Open, between UK time, between 6 and 9:30 in the morning, and between 12 and 2:33 in the afternoon. Well, see what happens here. So this would have been 7 a.m. in London, but it's 9 a.m. But my broker is 2 hours ahead of London. So 7 a.m. in London, 9 a.m. broker time, price forms a high. Where does it form the high? It forms a high into a previous day's order block. Boom, right? It's above Asia. So this intraday, you have your manipulation or your consolidation. Your manipulation, it breaks structure. Now, intraday, I'm looking at 1 hour to give me my, like I told you, I treat the 1 hour chart like my gospel oracle intraday. So in the 15-minute chart, it broke structure here on that day. But, so it broke this structure there. Takes out that low bricks market structure there. Right? Comes up back into this here. If you wanted, you could put a Fibonacci on it. I'm just going to guess that that's near the, there we go, Fibonacci, somewhere between 61.8 and 78.6, and then it goes. On the first day, if you're like me and you're very, very, very cautious because you're more experienced in these markets and you know that not every opportunity is a good one, you wait and say, does it form a 1 hour market structure break? And it doesn't form that 1 hour structure break until the end of the day. So on the 1 hour chart, that's the structure break there. This is the structure break here, right? And so you may not have gotten a trade on the 11th if you were very, very cautious. If you were more aggressive, you would have gotten in here and you would have made on that day alone 84 pips against a risk of 29 pips. So almost 3 to 1. But if you waited till the next day, so this is the market structure, it forms on the 11th. If you said, well, okay, now I know we are really going south, I'm just going to wait. And then now you draw your Fibonacci from here to there. That's the full range. Let's drop down to 15-minute chart. I know my chart's looking a bit messy now. So in essence, you're drawing it from the high of the 11th to the low that forms on the 12th after the market structure break there. Again, you can see it's between 61.8 and 78.6. It's the sweet spot. Now, this happened in Asia. But once you saw this on the 11th, you knew this was going to happen. Just put an order in and go to bed. You expect it to fill in London or New York, but if it runs in Asia there, you see how this ran up here? This is very unusual in Asia, but it gets there anyway. Your risk is a maximum of 34 pips. In that one day, you made 7 or 8 to 1. If you missed this in Asia, I'm going to take that Fibonacci, I would make it clear. If you missed this in Asia, look at the times it gave you another opportunity. 9:30 server time, so that's 7:30 in London. 7:30 in London, there is another chance. There's a retracement here, right? The moment this gives you a 1 hour, remember I said 1 hour is the kingpin. So this is the 1 hour engulfing here. You're in here. You put your high at the high of the day. Now that's a bit of a high. So that's 60, 650, 65 pips. I wouldn't have gone for that. I would have waited for another chance. But here you get the other chance. Where does it happen? I can bet you this is New York. There we go. 2:45 server time, 12:45 London time. You see there's another opportunity there. Again, if you put the Fibonacci from the London high to the low that forms before that, actually, from the high of the day, sorry, to the low that forms before that retracement. Again, you can see it's in the sweet spot. Can you see this? Between 61.8, 78.6. So you step in, right, with confidence, maybe halfway here. You take your trade there. You have a choice of here, 21 pips, or here, 37 pips. This is the safe one, 35, 36 pips, right? In that one day, you get almost 10 to 1. And the moment you get down to, remember this magic line there I told you about, right? See that magic line there? We got there on the 12th. The moment you get here, the first sign of retracement on a 1 hour chart, you are out. You're not sticking around waiting for your profits to be taken away. You get there, right? It starts to move back up. Yeah, you get out here. You've banked 7 to 1 and you wait. What do you wait for? The next day. And the pattern repeats itself every single day. See here? Asia, go up. Where is that again? Roughly, let's go to 15-minute chart. I'm trying to rush because I need to get off this in about 5 minutes. But I may come back later on tonight. I've got a meeting that I need to be in that's actually starting now. But I may come back tonight and show you more, or maybe just record it and post it on the group. So there we have it again. That's your Fibonacci, right? You're looking in the sweet spot between 61.8 and 78.6. So you got this opportunity here, right? If you came in here and you took it, but like I've taught some of you, I like to see somebody lose money. I like to see liquidity taken out. So when I come here, I've told you guys before, these two highs are too clean. See this high and that high. They're very near each other. They are begging for liquidity run. So if let's assume I took this here, I come back here, there's still reaction and I close here. On its way back up, I just know that the market maker is going to sweep that. It's begging. It's saying, take my money. Look, it's too clean, double highs in that region of 61.8. And price has refused the breakout of the low here. And when this happens here, bang, now I know they're ready to go. Look at what happens. Let's go to 1 hour chart, look at it. That would be here. From this point, look at what happens. You get in there. If you get, that's it, you get in there. You might actually know, you would get in here at the 1 hour engulfing here. Your highs there, maximum of 42 pips. Now, the stop losses are going to be higher because of the volatility, but the profits are also going to be higher. There we go. So that day alone, you get almost 3 to 1. You get roughly 3 to 1. The next day, it extends. The day after, the day after, the day after. And with what we've taught you already, you know how to find your entries either every day or every other day. Consolidation, manipulation, expansion, retracement. Now we get into this. Remember, this is a 1 hour or a weekly order block here. We expect a reaction whether or not the markets, the fundamental information is saying so. It will respect it. It may go further down, but it will initially respect it. However, around the same time, we start to hear about government with their intervention. And so you get out here and you wait. What do you know? You have a daily engulfing here. So this day is a bit petrid. And then on this day here, that would be the 24th, there's an engulfing. And so again, you start hunting market structure breaks in a 1 hour. So this is the 24th here. And so there we go. Structure breaks there, right? It goes up, it comes down, and it finds support at one of these, our magic lines. And then we start to reverse the process. So on Thursday last week, I didn't catch Wednesday because I was busy. Thursday last week, I showed you guys my trade. I caught the vast majority of this move up. I forgot my trade because I was so busy. It retraced a little bit, so I closed it here. I caught the move down because I expected a retracement. And when it hit that level, see the level it hit? The moment on a 1 hour chart, it retraced. I was out. This is where I got out. I wasn't waiting any further. I got out here because I know that we are still in sync with the retracement move on the 4 hour chart. And I expect that retracement move to bring us back to roughly the middle of this original consolidation here. I taught you guys that already. Roughly that middle there. We're approaching that point. If this turns out to be a full reversal, it will blow through it. But I'm waiting to see what happens there because this could just be the retracement and then we move to target. And here we are now. So that is the summary of how even in a crisis, understanding your fundamentals and your price action, you can trace, and you may not get a trade every day. There'll be times where your hunch tells you to buy or sell and you were right. Don't follow your hunch until you can back it up with clear price action. For instance, here, there are days where we could have jumped in and made money, but we were waiting for the textbook price action. And when we get the textbook price action, you usually get far more. So here, yeah, you'd have made a bit of money, but if you waited for this one, boom, shakalaka, and there you go. All right, guys, so I'm gonna have to end it there. I need to jump into a meeting right now. What I may do is I may come back and look at my charts and plot out opportunities for this coming week and invite you to do it. Also, Mondays and Thursdays, we're gonna be doing live analysis together. So tomorrow, while we're planning out the week, I'll send you the invitation when I'm in front of my charts to see what opportunities we're looking for. Good luck. Have a great week. Bless you. Take care. Bye-bye.